Welcome to After the Paycheck, the series dedicated to helping people to and through their retirement process. I'm your host, Adam Bly. This week I am here with Ryan Marston.
Pleasure to be back here.
Are you looking good with the longer hair? Are you letting it grow out a little bit?
Yeah, a little new style over the last few months.
It
was really long, and then I got a haircut and kind of changed it up a bit.
I had to go the other extreme. I had my wife was trying to help me buzz my hair, and we kind of went skin to skin with a little mishap, and now I've got the whiffle going.
You're a courageous man. I was not ready to let my wife do that.
My hair was getting so out of control. I was like, I gotta do something, and I paid for it.
That's fine. Yeah.
We are here in the office at Rubino and Langwald Partners in Newton, Massachusetts, and we were discussing, and it's just you and me in the office today recording this episode, and we're still making sure that we're keeping socially distant and doing a responsible thing here. And we had been talking before we came in to record this about how I'm watching the news at home, and I see financial experts and economic experts saying one thing, the other thing. I'm looking at one channel, and they're saying that the market is now up for the year. Things are looking great. We've already recovered. Other channels are saying that, like, okay, this S&P is getting there, but it's not quite there. And then I flip back to the other channel, and they're saying that everything's positive. And I said to you, I go, I don't get it. Like, why are people saying different things? And you informed me that there's different markets.
There is. I think a lot of times when people go home, they turn on the news, whatever channel it may be, you hear what the Dow Jones did for the day, what the NASDAQ did for the day, what the S&P 500 did for the day, and those are all very different types of indexes. There's some overlap, but they're very different in how they're calculated and what their actually makeup is that have allowed, the NASDAQ all of a sudden hitting new highs, like historically new highs, not just like on the year, right?
Right.
And you're wondering how it's going on and what's happening inside that index. Maybe it's not relating to your own retirement accounts or what's going on with the economy, right, or the economic indicators. But it's a little bit misconstrued, or people just don't understand how they're made up.
That's what it comes down to. As someone like me who is not as financially savvy as the average investor, I can't imagine. I've been working one industry my whole life, and then it's time to retire. I should understand all of this right away. Yep. So I thought this would be a great episode to kind of understand what those different markets are, what they're comprised of, and how they may or may not have an effect on your specific retirement accounts, and then really why understanding this information can help me on my retirement planning journey. So again, you were just talking about the different markets, NASDAQ, S&P, Dow Jones. What are they, and why do they have different numbers every day? Yeah,
I think it's really crucial right now to kind of have some sort of understanding on how those are made up, what it means, for two reasons. So you can see how it relates to your maybe portfolio, because there might be, you see what's going on in the news and it's not relating to your portfolio. You should understand why before you go forward and making any potential changes, right? Because you don't want to jeopardize, future potential gains either, just because you might have lacked on what's happened or lagged the overall markets in the last few months.
Right.
And I think it's the case with most people, which we'll kind of get into a little bit. Yeah.
Perfect.
Yeah.
So let's actually get into it. So let's go into the different types of markets that there are.
Yeah, so like the three main ones, what we talked about is the S&P 500.
Okay.
I think is probably the most commonly used one. The Dow Jones Industrial Average, and then the NASDAQ 100 we'll talk about. But the S&P 500 is an index made up simply of the 500 largest market cap companies, right? So of the 500 companies, it's not evenly, each company owns the same percentage share of the S&P 500, right? And there is 11 sectors, different sectors of the S&P 500. Tech, utilities, etc. Things, and 9 others. But the top 5 percentage weight or stocks of the S&P 500 actually account for about 27% of the index right now. 27%.
Wow.
So the other, 495 account for 73%. So 5 stocks account for 27%. Back in February, those 5 stocks actually only accounted for 20%. And I'll we'll talk about those individual stocks and going right down in a row. It's it's Microsoft, Apple, Amazon, Facebook, and then Google or Alphabet. Those are the top 5, right? And all 5 of those companies are positive on the year. So when they own 20% exposure of that index, of that 500 company index back in February, and they've just continued to really skyrocket. The worst return on it, I think any of them right now is it's actually Google right at 8% on the year.
Apple's the worst return,
exactly.
8%.
I mean, Amazon's up 45% year to date.
Wow.
So when the third largest company on that index with a pretty high percentage exposure is up 45% on the year, it has a bigger effect on that actual index, right?
Gotcha. Okay.
So of those 27% of that index is up pretty significant numbers, which kind of misleads to what the other 495 stocks in the index are potentially doing, right? Because it offsets them by a greater amount. And kind of getting into the sectors a little bit, there's 11 broad sectors. Energy's the real laggard, financials, etc. Of those 11, only 3 are positive on the year, and tech is up 12%. So
wow.
When you see things are, we're almost back at even, or things are going well, that's not necessarily the case across the board.
Right.
Tech has the highest weight on a lot of these indexes, and tech has done very well, which has led the charge in the recovery. Yeah.
I think when you were talking about the individual stocks and like how these big players that have such an influence over what the rest of that S&P 500 index does, and how that actually comes into play. You're going macro, this whole big thing, and then you go into individual stocks, and then I think about my personal portfolio and how it's balanced, and I might not actually have any of those stocks in my portfolio, which means that I could actually be still way down on the year, even though the market has done
exactly. So that
quote unquote rebound.
So if you have mutual funds, right, and then talking about large cap and even the S&P 500, there's really 2 types of stocks. Okay. There's a value stock and a growth stock. The tech stocks are the growth stocks. That's what's again led the charge, up double digits on the year.
Yep.
The value companies are still down double digits on the year.
Okay.
So you might have a large cap value fund. A lot of these mutual fund companies have them, or a large cap growth fund that's actually up.
Okay.
So depending on what your exposure is into each of the sectors, it really determines like what your return is on the year right now. So that might be a big reason on why you're lagging. And then there's a lot of carryover from index to index, right? So getting into the NASDAQ or the NASDAQ 100, the top 100 stocks of the NASDAQ, the top 5 stocks, which are the same exact
ones,
5
right?
stocks in the S&P 500, a slight change in the order, but those account for 47% of the index.
Well, it's like you just took 500 companies and now you just reduced it to 100. But if those same 5 players are in that index now.
The same 5 in that 100, and it's mostly a tech index. They account for 47%. And when you have returns like we've seen in the year, that's how the NASDAQ 100 is hitting new highs.
Okay.
But not many people in their portfolios at home are going to have that exposure to those individual stocks, and that's why any truly diversified, portfolio at home is probably lagging what you see on the TV when you turn it on at night.
Okay. Yeah. So when I'm, like you said, I'm looking at my account and I'm like, wow, I'm still down 4% on the year, and I'm looking at the NASDAQ and it's up whatever right now, and I'm like, geez, like I'm getting ready to fire somebody, or talk to somebody else because I'm upset that I'm not doing the same as these.
Down 4% is not that bad though.
Comparatively, for everything going on,
Yeah.
But I forget where I was going with that. But it goes back to I think you can make stats work any way that you want and manipulate them. And I think that's, and this isn't like the whole like, hey, we're gonna like hawk on the media kind of a thing. But it's interesting that people will just blindly say like, oh, they look at the whatever that news channel is, and they say, oh, it looks like the NASDAQ is up for the year, so I must be doing well. I must be ready to retire, and I'm back to normal, and all these things. When if you actually look at your account and take a kind of a screenshot of it versus what you saw on that screen today, there's going to be differences.
Exactly, and like I think the point you want to get, or I'm trying to get across, is you don't if you're lagging what you see on the news at night, you don't want to make extreme changes right now, right? And all of a sudden move into these large cap growth companies, because the ones that are lagging eventually, should pick up.
Right.
And historically speaking, small cap companies have really led the charge out of a recession, not large cap growth like we've seen.
Okay.
Small cap companies are still down mid-teens, 15% or so. So those are still lagging, which there is opportunity when the recovery comes for these small cap companies, these mid cap companies, and large value companies.
So you're talking about small, mid, and large cap. What defines a small, a mid, and a large cap?
It's market capitalization of their, the stock, and how much equity is really out there.
Okay.
Across the board. But ultimately, it's a small company. It's a smaller company, and then not to get too technical, then there's mid caps, and then there's large caps, which are the ones that these giant companies. Exactly.
Okay.
So.
So it's when, like you said, when the small companies typically are the ones that are kind of leading the recovery. They're the ones that are lagging behind right now.
Exactly.
And your portfolio might have them in there, but it doesn't mean that you should have a knee-jerk reaction and say, I want to put all of my money in Amazon because it's up 45% of the year, because...
You probably missed the boat on that. I mean, there's nothing to say it's not going to continue, but just because something is up 45% on the year doesn't mean it's going to be up 45% on the rest of the year going forward, right?
Yeah.
So the value might not be there going forward. You might have missed that opportunity.
Right.
So you want to just make sure you still stay diversified. I think that's the number one thing. You want to make sure you stay diversified, because everything eventually will catch up. The other asset classes will catch up when the economy does recover, and hopefully sooner than later.
So when we talk about people saying if the economy is going to recover or when the economy is going to recover, what are some of the indicators that they're looking at? And what are some things that might have triggered people to kind of get out of the market or go to a more conservative portfolio now and kind of miss this upswing from everything we're seeing now?
In my opinion, there's a big disconnect between what's going on in the market and the economic indicators right now, and that's why a lot of portfolios rebalanced to more conservative natures back in March. Jobs, unemployment rates, companies' earnings, etc. But the market's very forward-thinking, and that's part of it. It is projecting a return to GDP, somewhat in the fourth quarter, but it's not necessarily listening to what's going on with these economic indicators right now. And then the federal government, in their stimulus packages, has infused a lot of money into these markets, which has not been something they've done historically speaking. The bond purchasing agreements, whether it's been high yield, corporate, treasuries, and that has really put a lot of money into the market that has helped really start this recovery process.
Okay.
There's potential long-term effects. If there's too much money put into the economy, then the dollar could suffer. That was
going to be my next question.
But it has helped things a lot through the last few months in terms of this recovery that we have seen. Yeah.
Okay. So thinking of indicators and everything going on right now, is there anything that I could be reading or seeing that could help me right now with my accounts in my portfolio? If I'm kind of trying to DIY it, is there anything that if this is happening, this is usually like a precursor to something catastrophic, or hey, this could be really great if these things happen? And has there been a history of things where those indicators end up not being true?
There are. I mean, again, getting back to the Fed and the indicator, I think the indicators, a lot of them pointed negatively, in April, but the Fed came in with these packages and propped up the market.
Right.
Hopefully things continue and, we don't have a relapse of what's going on, which is, the concern right now. But I think the Fed is willing to go to any means, and it's tough to price that in becoming too conservative. So, I mean, I like to remain optimistic, but cautiously optimistic going forward, right? Because there is a lot of red flags out there that you got to be aware of. Okay. And I think just making sure we're in a volatile market right now, making sure you stick to your original game plan, right? Mm-hmm. That is more crucial now than ever. In your asset allocation.
Right.
So when we see these big swings with individual asset classes like we've gone into, like large cap growth has seen a significant rise, but large cap value is down 10%. You want to make sure you're rebalancing, because those original allocations you had can get really out of whack.
Okay.
And if large cap value's dropping 10%, but large cap growth is gaining. Well, large cap growth, just like the S&P 500, has taken over a bigger portion of your portfolio, right? And it's not to say that continued growth is going to go forward. So you want to always remain with your original asset allocation model, and make sure you're rebalancing.
So we're two guys in our mid-30s that are having this conversation, and we're thinking, in a few years, if I'm within 5 years of retirement and I've come up, or I've spoken with an advisor, and I have an actual retirement plan laid out in front of me, how often should I be communicating with them, or how often should they be communicating with me about rebalancing or letting me know about what my asset allocation is, or if I should be, I don't want to say nervous, but if I should be aware of some changes that are happening that I should be kind of either making moves on, or my advisor will tell me that I should or shouldn't do this?
Yeah, in years like this, I'd say probably frequently. If there is a change being made to your portfolio, the advisor should be reaching out. If there's something you don't understand within your portfolio, you should reach out to them.
Okay.
And I think, again, in a volatile market like this, things seem to be changing on a daily or even weekly basis, not even monthly. Like in a normal year, and things are just trending up. Last year was a good year.
Right.
It's maybe not as important to reach out as frequently. Certainly want to have a yearly review, maybe semi-annual. But in times like this, when we're seeing significant swings, it's important to stay in contact and know what your portfolio is doing, so you have a true understanding when you turn on the news at night and say, oh, this is what the S&P 500 did.
Right.
Yep.
Is there a point where I'm kind of overdoing it if I'm just like watching the stock market every day? If I still have 5 years to go before I retire, is that
you might drive yourself crazy this year a
Okay.
little bit, because I do think there's going to be continued volatility for a while. Not necessarily in a negative fashion, but it's just going to be a very volatile market until things are settled, and that could be a year from now.
That's a term that I've heard is called the market might get tested. What does that mean? Like, we might test the market, or the market might be tested before we see an actual recovery.
There's different resistance levels, like within the S&P 500 or the Dow Jones, when it hits certain levels. Testing it would be a negative outcome of that test would be a pullback when you hit that level. If you break through it, it's usually a positive sign, and it continues. So sometimes when you hit these resistance levels and you actually go through it, you actually want to remain either invested or get back invested when that happens.
Okay.
Yeah.
So kind of coming back to it all, we just discussed the different types of indexes that the media covers and that people are always referencing when they're talking about the market.
Yeah.
There's actually multiple markets.
Yeah, but those are the 95% of the time, those are the big three that
Gotcha.
they're talking about.
And you, depending on how your portfolio is made up, you might be in some of them. You might be out of them entirely, right?
Yeah.
It's like that's a possibility, right? I could not be involved in any of the companies that are comprised of any of these markets, right? I'd have to be a really weird index I'd be in.
Yeah, those are all. That would mean you're not. If you're invested in equities, right?
Okay.
And you're not in those, that means you're not in large caps. Okay. And historically speaking, and over the past 6 years, those are the best performing asset classes. So if you're not in that, you're probably not doing too well right now.
Okay.
It means you're in small cap, mid caps, international. And those are going to make your portfolio extremely volatile. But I'd say that if you're invested in equities, that's very rare if you're not in some sort of exposure to some of the companies.
Something in there, right?
Whether it's, again, individual stocks, ETFs, or mutual funds. Yeah.
What are ETFs?
Exchange traded funds. So it's ways of having it's cheaper. First of all, an exchange traded fund is a lower cost, generally speaking, than what a mutual fund is. And it's ways of investing in these broad indexes. Like you can buy an S&P 500 ETF. A few companies have them.
Okay.
And you get S&P-like returns with that exchange traded fund. And the expense ratios are, generally speaking, lower than what a mutual fund is.
Okay.
Where a mutual fund, that mutual fund manager is buying and selling these individual stocks a lot of the times, right? And they're managing differently, not necessarily to how the S&P 500 is. So and then getting more specific, you can buy an ETF that invests in just the financials within the S&P 500 or just the tech within the S&P 500. So you can move from sector to sector or S&P 500 value, S&P growth. So there's thousands of different ones.
Yeah.
The cost is lower, and in good times, the performance is usually pretty high. Yeah, and when you do that, you remove single stock exposure and that company potentially going under.
So that's a plus side.
Yeah.
Is there a negative to an ETF?
Maybe over diversification. There's going to be if you buy an S&P 500 ETF, you own everything in the S&P 500, so you can't remove it. Or you buy a Dow Jones. We didn't get too much into that, but Dow Jones is comprised of it's the 30 largest companies. 30 companies, excuse me, by price share. They do it differently than the S&P does, so it's by price.
Okay.
And of that 30, and the Dow Jones is down still 8% right, as of now on the year. But Boeing is in there. When you buy a Dow Jones ETF, you get a share. You're owning a piece of basically Boeing, and Boeing's down 45% year to date, and that's why ExxonMobil is in there. Dow Chemical is in the Dow Jones Industrial Average right now, and those companies are all down upwards of 25% on the year. Okay. So the downside is maybe over diversification, but diversification will truly reduce the volatility of your portfolio.
Okay.
Yeah.
So
or should.
It should. Yeah. This is. I know that we kind of got really technical right there.
You did, yeah.
It gets a little overwhelming.
It does. It does.
And trying to think of myself as someone who is, again, getting ready to retire in 5 years, maybe 10 years, and I'm trying to think of all of these things. At what point do I look at my retirement portfolio and I say, you know what? I've been contributing to in this for years or whatever. My 401k company has been taking care of all of this, and it's just, I'm in a target date fund, right? We did an episode on that, what target date funds are. And it's automatically balancing this, that, the other. At what point would it behoove me to actually sit down with an independent person and say, hey, I just want to make sure that my portfolio is balancing the right way?
Yeah, I think as you're getting closer to retirement, within 10 years, 5 years of retirement, it's really important to just not own a basket of funds, because especially if you don't understand how they work or how they're investing. Because in markets like this, it can really set you back if you're not investing appropriately to your age and where you are in your retirement horizon. So again, sitting down with someone, you don't necessarily have to. If you don't want to know all the technical side of it, you got to make sure you're sitting down with someone who does know the technical side of it and knows how the portfolios are working, knows how to invest your money. But I think just investing in a target fund because you think it might be cheaper, or there is some risk there as you're going into retirement, that even though if you're retiring next or this year, say, and you're in a 2020 target fund, it's not necessarily going to give you the performance or the safety you need as you're getting closer to retirement.
Gotcha.
Right? It's still going to have those losses like any bad stocks or bad funds or bad ETFs potentially.
And that's why it's important to sit down with somebody that understands that technical aspect and actually understands your situation too, because I think, like we talked about in that target date funds episode, is, I might say that I'm going to retire in 2020, but I had lost my job for 2 years, for a few years before that, and all of a sudden I need an extra 30 grand in my retirement accounts before I'm actually at a point where I could comfortably retire. But because I'm set at a 2020 target fund date, it doesn't really think that I need that money. It's just thinking like, oh, because you're this age and this close to retirement, we automatically put you in these portfolios. Yeah,
I think, again, it's an investment. As you're younger, it's not a bad thing. If you're using a target fund as your retirement advisor, so to speak, right?
Yeah.
It's probably not a good idea, because you're lumped into this fund with thousands of other people.
Right.
That fund doesn't know what you have for outside income sources. That fund doesn't know what you have for expenses, or what you want, where you want to go on vacation, what you want to leave to grant. So if you're using the target date fund again as a quote unquote like your retirement advisor, you could run into some trouble.
Right.
Yeah.
You're just a number.
You're exactly.
Okay.
Yeah.
Good to know.
Yeah.
Because this was a bit of a technical episode, if people had questions and they submitted them on After the Paycheck, would you mind if I forward them to you?
Absolutely not.
I'm going to have no idea how to answer any
That's
of these.
what I'm here for. Yeah, absolutely not.
So we'll do that. So if you have any questions and you want to send them, or if you want to actually just book a time to speak with Ryan, you can either head to 365retirement.com and do that, or just fill out the form on afterthepaycheck.com, and we'll get you in touch with either Ryan, John, or Sam to kind of sit down and discuss your situation and see if it makes sense for you to have a further discussion to talk about your individual situation if you're heading into retirement.
I think that's, again, it's crucial in years like this, really hammer it home why.
Yeah.
So.
Ryan, thank you for taking the time. I know this was a very technical episode, so thank you for breaking it all down for me.
Hope I wasn't too confusing, but
no, it was
pleasure being here.
Awesome. Thanks, Ryan. All right. Take care.